The repo rate. If the repo rate is increased, it can have several effects on the banking system. Increased borrowing costs. When the repo rate is raised, it becomes more expensive for commercial banks to borrow funds from the central bank. As a result, banks may pass on this increased cost to their customers by raising interest rates on loans and other forms of credit. This can lead to higher borrowing costs for individuals, businesses, and other borrowers, which may reduce demand for credit and borrowing activities. Impact on deposit rates. Banks may also adjust their deposit rates in response to an increase in the repo rate. To attract more funds from customers, banks may offer higher interest rates on deposits. This can incentivize individuals and businesses to save more and deposit their funds in banks, as they can earn a higher return on their savings. Higher deposit rates can also help banks reduce their reliance on expensive borrowing from the central bank. Impact on lending and economic activity. Higher borrowing costs resulting from an increased repo rate can have an impact on lending activities and overall economic activity. When borrowing becomes more expensive, businesses may delay or reduce their investment plans, which can slow down economic growth. Similarly, individuals may cut back on discretionary spending and delay major purchases due to higher borrowing costs. This can have a dampening effect on consumption and overall economic activity. Tightening of monetary policy. An increase in the repo rate is typically seen as a tightening of monetary policy by the central bank. It signals a desire to control inflation and may be implemented to curb excessive borrowing, manage liquidity in the banking system, or stabilize the currency. By raising the repo rate, the central bank aims to reduce the money supply, curb inflationary pressures, and promote price stability. Impact on profitability and financial health of banks. Higher borrowing costs resulting from an increased repo rate can affect the profitability and financial health of commercial banks. If banks are unable to pass on the increased costs to borrowers, their net interest margins may be squeezed, potentially impacting their profitability. Banks may also face challenges in managing their liquidity needs as borrowing becomes more expensive, which can have implications for their financial stability. It's important to note that the actual impact of an increase in the repo rate on the banking system depends on various factors, including the level of existing interest rates, the overall economic conditions, the financial health of banks, and the transmission mechanism of monetary policy in a particular country. Banks closely monitor changes in the repo rate and adjust their strategies and operations accordingly to adapt to the changing interest rate environment. The repo rate.
Thanks for watching today's video. Be sure to like and subscribe for more content like this.